The clock had barely moved past 9 in the morning when the news broke. And Amsterdamor or Inter in Brur and Sexian, President Donald Trump had signed a significant new executive order on trade. By the time most Canadians were settling into their workday, the Canadian government had already formulated and delivered its initial response. Before noon, that rapid sequence of events marked what many are calling Trade War Day Zero, and Semmelmemorkinur and near or sure inter inber inber, a moment that could reshape supply chains, jobs, and daily costs across the country. Welcome back to Canada Pulse. I appreciate you being here with us during what feels like one of those days where the pace of events accelerates and the stakes become immediately clear. These are the moments when decisions made in Washington and Ottawa directly touch Canadian households, factories, farms, and family budgets. We're going to walk through what happened today with the context it deserves, the implications that matter, and the measured analysis you've come to expect from us. If you value steady fact-based reporting on how federal policy and international developments affect real life in Canada, I hope you'll stay with me through this. Let's start at the beginning of this particular day. According to reports from Washington, President Trump signed the executive order around 9 a.m. Eastern Time. Details are still emerging, but early indications point to targeted measures affecting key sectors of cross-border trade: autos, steel, aluminum, energy components, and potentially broader categories. The move appears consistent with the administration's ongoing efforts to address trade imbalances, border security concerns, and domestic manufacturing priorities. What stood out immediately was the speed of Canada's reply. Before noon, Prime Minister Mark Carney's office and the Department of Finance had coordinated statements, technical briefings were prepared, and initial retaliatory measures were outlined. This wasn't a hastily drafted press release. It reflected weeks, if not months, of contingency planning by federal and provincial officials. You could almost feel the tension in newsrooms across the country as the morning unfolded. Anchors adjusted their scripts live. Traders on the Toronto Stock Exchange watched key sectors react. In communities from Windsor to Oshawa, from Sarnia to Fort McMurray, workers and managers checked their phones for updates that could affect shifts, contracts, and long-term planning. This isn't the first chapter in Canada-US trade tensions during this period, but today carried a particular weight. It felt like the formal beginning of a new phase, Day Zero, where both sides have moved from rhetoric to concrete action. To understand why Canada was able to respond so quickly, we need to look at the preparations that have been underway. Since the early signals of renewed tariff threats, the Carney government, working closely with provinces, industry associations, and trade lawyers, has built detailed response frameworks. These include lists of American goods that could face counter tariffs, support programs for affected sectors, and diplomatic channels kept warm even during difficult periods. Mark Carney himself brings a particular set of experiences to this moment. As a former governor of the Bank of Canada and the Bank of England, he has deep knowledge of how markets react to policy shocks. His public statements today emphasized measured resolve, protecting Canadian interests while leaving room for negotiation. He spoke about the integrated nature of the North American economy and the costs that would be borne by citizens on both sides of the border if escalation continues unchecked. Let's talk about what this order could mean in practical terms. For the auto sector, which employs tens of thousands directly and supports hundreds of thousands indirectly, any new tariffs on vehicles or parts threaten the finely tuned supply chains that crisscross the border multiple times before a finished car reaches a dealership. A part made in Ontario might cross into Michigan for assembly, return to Canada for finishing, and head back south. Each crossing becomes more expensive under new duties. In energy, the picture is complex. Canada remains a vital supplier of oil, natural gas, and electricity to the United States. Previous measures sometimes exempted energy or applied lower rates, but today's developments suggest renewed pressure, even in this area. Alberta and Newfoundland producers, pipeline operators, and refining communities will be watching closely. Then there are the consumer impacts. Many everyday items, konsumtionsnormer and sector E, from groceries to household goods to building materials and could see price pressure if retaliatory measures expand. While governments try to shield essentials, history shows that trade disputes have a way of filtering through to store shelves and family budgets over time. I want to pause here and acknowledge the uncertainty many of you might be feeling. If you work in manufacturing, agriculture, trucking, or any export-related field, today's news likely landed with personal weight. That's understandable. These aren't abstract policy debates. They're about paychecks, overtime opportunities, and community stability. On the other side, many Canadian businesses have spent the last year diversifying markets, strengthening domestic supply chains, and building financial buffers. Provincial governments in Ontario, Quebec, Alberta, and British Columbia have been active in their own planning. This coordinated federal-provincial approach appears to have enabled the swift response we saw before noon. The opposition parties offered their perspectives quickly as well. Conservative leader Pierre Poilievre criticized the government for not preventing the escalation, while emphasizing the need for stronger negotiating leverage. The NDP focused on protecting workers, and the Bloc Québécois highlighted impacts on Quebec's aerospace and manufacturing sectors. These differing viewpoints reflect the healthy democratic debate Canadians expect during moments of economic pressure. Let's go deeper into the history that brought us here. The Canada-United States-Mexico Agreement, which replaced NAFTA, was always meant to provide stability. But review periods, political changes, and shifting priorities in Washington have tested that framework repeatedly. Previous tariff episodes on steel, aluminum, and softwood lumber taught both countries painful lessons about the costs of prolonged disputes. What makes this period different is the scale and the speed. Global supply chain rethinking, concerns over critical minerals, energy security, and border issues have layered new complexities onto traditional trade disagreements. Potash, critical minerals, electric vehicles, batteries, entire sectors that once seemed insulated are now part of the conversation. For Saskatchewan, today's developments add another layer to ongoing discussions around fertilizer exports. For Ontario, it's about autos and advanced manufacturing. For Alberta, energy. For British Columbia, forestry and ports. The regional impacts vary, but the national interest in a stable, predictable trading relationship remains consistent. Economists we've spoken with today caution that while markets hate uncertainty, they have also priced in a certain level of ongoing friction. The Canadian dollar's movement, bond yields, and sector-specific stocks will tell part of the story in the coming days. But the fuller picture will emerge in factory floors, small business order books, and provincial budgets over the coming months. Prime Minister Carney's team has emphasized proportionality in any Canadian response. The goal, they suggest, is not escalation for its own sake, but protecting Canadian workers and industries while keeping channels open for dialogue. This approach mirrors strategies used successfully in past disputes, in ensure and firm but measured. Yet challenges remain. The integrated auto sector is particularly vulnerable. Parts crossing the border multiple times mean even modest tariffs can compound quickly. American consumers ultimately pay higher prices for vehicles, while Canadian producers face margin pressure. It's a lose-lose dynamic that both sides have historically tried to avoid through negotiation. There's also the human element that often gets lost in the numbers. Think of the welder in Windsor who has built a career on cross-border supply chains. The truck driver running routes between Detroit and Toronto. The engineer in Waterloo designing components for North American vehicles. The farmer in Manitoba or Saskatchewan whose fertilizer costs and grain exports are linked to these relationships. These are the people behind the statistics. As the day progressed, we saw measured reactions from industry groups. The Canadian Vehicle Manufacturers Association, the Canadian Chamber of Commerce, and provincial manufacturing associations called for calm and continued diplomacy. Unions emphasized the need to protect good-paying jobs. Everyone seems to agree that prolonged uncertainty helps no one. Looking ahead, the coming weeks will be critical. How quickly can negotiations begin? What sectors will see the most immediate pressure? Will there be targeted exemptions or carve-outs as both sides assess impacts? These are the questions markets, businesses, and families will be asking. Canada holds certain advantages in these discussions. We are a stable, reliable supplier of resources and energy. We share the world's longest undefended border and deeply integrated supply chains. Our legal and financial systems are strong, but we are also the smaller partner in this relationship, which requires smart, strategic engagement. Mark Carney has spoken in the past about building economic resilience, diversifying trade partners, investing in skills and technology, and leveraging Canada's strengths in critical minerals, clean energy, and human capital. Today's events test how far along that path we truly are. For viewers watching from across the country, here's what matters most in the short term. Monitor announcements from your provincial government on support programs. Businesses should review contracts and supply chain vulnerabilities. Households may want to keep an eye on sectors that could see price changes. Vehicles, fuel, certain groceries, and building materials. This is not a moment for panic, but for informed attention. Trade disputes have come and gone before. The The North American economy has shown remarkable adaptability over decades. Yet each new episode carries lessons about the need for diversification and strategic foresight. We'll continue following every development closely, from Ottawa's negotiating rooms to affected communities, from Washington announcements to market reactions. Canada Pulse exists for moments like this, to provide clear context, balanced analysis, and practical understanding when the news moves quickly. I'd genuinely like to hear from you in the comments. How are today's developments affecting your work or your community? What do you believe should be Canada's priority in responding? Where do you see opportunities for stronger economic resilience? Thank you for spending this time with us on what has been a significant day in Canadian trade policy. We know your time is valuable, and we don't take it for granted. If this kind of steady, in-depth coverage matters to you, consider subscribing and joining our community. We'll be back with updates as this story evolves, because it will evolve. Stay informed, stay engaged, and take care of one another. We'll see you in the next report.